Hello everyone, and thank you for attending the first investment update of the year. First of all, just to wish everyone a happy new year on behalf of Allan Gray and the investment team, and I hope the year turns out much better than I think it's going to be. In 2024, as we've been speaking about, was the year of global elections. So never in the history of mankind has a greater proportion of the world population gone to the voting polls. And normally as bottom-up investors, we don't pay a huge amount of attention to politics because if we look back at history, it hasn't tended to make that much of a difference. But we kind of felt 2024 was different, not just because of the sheer amount of people that were voting, but just how different the policies were between the various different governments. And just to take a look at it, you only have to look at South Africa, the reaction of our asset markets to the election and the government of national unity, and for example, to the Republican clean sweep of the US elections. And it's fairly clear if you look at it that markets were pricing assets differently based on political outcomes. And it's actually quite amazing to think that France doesn't actually have a government at the moment, effectively nor does Germany, and we've seen what's happened to the Labour Party in the UK. So we did think politics made a difference in this year. If we look back to 2024, it was a decent year in terms of returns. The all-share index returned 13%. Inflation was around 3% in South Africa, so good real returns in terms of history. But the real star was the bond market. The all bond index returned 17% in rands. And to put that in perspective, the country that most people compare us to is Brazil. We outperformed Brazilian bonds by 50%, 5-0, right? So it does show you, and why has Brazil weakened? It's because of politics and poor fiscal policies there as well. I guess the other sort of asset class that has been really strong is the dollar. So the rand, even though it weakened 3% over the year, was actually one of the strongest currencies in the world last year versus the dollar. Those sound like great returns in South Africa, but internationally it was even higher. So global equities returned somewhere around about 19% in dollars. And interestingly enough, the global bond index actually produced a negative return of around 3%. But within the global markets, America was obviously much stronger. So the American market produced a return, if you look at the S&P 500, of around 25%. And interestingly enough, that's 2 years in a row where the market's done 25%. And that's only happened, I think, 6 times in history. So markets dominated by the US. And the way people have described that is it's a narrow market, or it lacks breadth. And what does that mean? It means, well, global equities returned 19%, but most of that was the US. And within the US, almost all the returns were generated by the mega cap tech companies. Now, these companies like Apple and Microsoft and Alphabet and Nvidia, these are great companies, but the valuations are very high. And really what pushed the stocks last year, after having a good year before that, was really artificial intelligence. So the market is focusing on all the amazing things that are happening in the AI world, and we think it's probably going to change the world, but it's very difficult to work out which companies are going to be the winners and how it's eventually going to work out. Interestingly enough, between those, what people call the hyperscale IT companies, their capex this year is forecast to be $250 billion. And that's just on the data centers. And that obviously brings into account chip companies. So you would have seen 2 of the best performing sort of stocks are Nvidia and Taiwan Semiconductor. And if we look at the markets and how narrow it was, that means it's very tough to be an active investor. On the numbers I've seen from Bank of America, only 30% of large cap managers in America managed to outperform the S&P 500 because you really had to be overweight those big stocks, and those 7 shares make up 30% of the S&P 500, which is one of the highest concentrations in history. The other thing I think that we looked at a lot this year and really affects the South African stock markets, and we've spoken about it many times, is China. So the continued weakness in the Chinese economy has really surprised a lot of people, not us. Interestingly enough, even though the Chinese economy continues to disappoint, the stock market actually did quite well over the last year, despite being a poor place to be invested over the last sort of 15 to 20 years. And this Chinese weakness in the economy has brought about an interesting thing, sort of disinflation almost turning to deflation in China. So quite remarkably, the interest rates or the yield on the Chinese long bond is now below that of Japan. And why does that come about? Well, China's local economy is weak, but they're still producing the same amount of goods. So a lot of overcapacity, which they're exporting to the rest of the world. And why do I say it's important to South Africa? Well, it's not only important because of Naspers or Richemont, which obviously rely a lot on China. It's really got to do with commodity prices as well. So China's the majority sort of customer for most commodities, and we've seen those commodities being weak, which obviously feeds through into the mining companies in South Africa as well. It's going to be interesting to see what happens in China over the next year or two, because we've kind of reached that sort of point in the Chinese economy where the transition from build and invest to consumption is proving far more difficult than I think the Chinese government thought. The one fascinating thing we found over the last year, and it's quite difficult to explain, is this overconsumption sort of that's come over from COVID. And what I mean by that, during COVID, people got stimulus checks, they got money, they weren't traveling, so they spent a lot of money on goods, on merchandise. And we've seen a lot of companies sort of have a bit of a hangover from that, where it's difficult to tease out what's a slow economy and what is really people having spent a lot of money during COVID and now spending money on different things. As an example, I encourage everyone to go and have a look at the share price charts of something like Pernod Ricard or Diageo, the spirits companies. The people spent a lot of money on alcohol during COVID, and you still got it in your pantry, etc. So that's something we're looking at, and including for Richemont, luxury goods sales, which had a very, very big sort of boom in terms of sales in COVID. And we've tried to add in the portfolio stocks that would benefit from the opposite trend, which is experiences, something like Booking.com, where people are traveling a lot more than they were. Interestingly enough, during the year, and not many people would have predicted this, which asset class performed almost exactly the same as the S&P 500, and that was gold. So most people think of gold as a hedge when equity markets are going down or the world's in trouble, but gold also returned around 25%, which is pretty interesting. And the other interesting thing that happened with gold kind of has an inverse relationship with real interest rates. So when real interest rates are high, gold tends to perform poorly and vice versa. Now, another sort of inflation hedge that people talk about, and it's not something I understand very well, but everyone to themselves, is Bitcoin. So Bitcoin traded over $100,000 after the US election. And something else happened in America, which is quite strange. As everyone is aware, the Federal Reserve has started cutting interest rates. In other words, they're bringing interest rates down at the short end, but from the very day they started cutting interest rates on the short end, the long end, in other words, long-term interest rates, started rising. And that's very, very unusual. And so when I look at these three things together, what does it tell you? Gold being strong, Bitcoin being strong, and a strange occurrence in the US yield curve, that kind of tells me that the market is worried about inflation over the longer term. So that's something we're watching quite closely. And if we look at bond markets globally, that's probably, if you had to say, the biggest risk in 2025 is long bond yields. So whether it's the UK, whether it's the US, whether it's Europe, all those long bond yields are rising quite significantly. And if you're a very indebted government, which most governments in the world are, paying 5% on your debt is very, very different from paying 1%, which you were paying a couple of years ago. If we just come to the local markets, obviously the big story of the year was first the election, and then after the election, the formation of the Government of National Unity. So you can just go and look at the charts. Straight after they announced the Government of National Unity, almost all asset prices in South Africa went vertical for a couple of months. And that's really the market starting to discount the future. So the kind of companies we're talking about that did very well are what we call SA Inc. companies. So those would be more domestic cyclical companies like sort of banks and retailers and insurers and food producers and property companies. All their share prices ran up significantly the couple of months after the election. Now it's strange for me because if you think about the election, even though the ANC lost its majority, for me, it wasn't like the population voted for other parties. It was just really the ANC lost to the MK. Right? If you add the MK's 14% back to what the ANC got, the ANC would have had a majority. And if you look who the MK are, they're just really the bad remnants of the ANC. So that's another risk we kind of see for the year. And why did the share prices re-rate? So the share prices re-rated of something we've been focusing on in our commentaries over the last while is the two determinants of value. So the cost of capital and growth. Now, obviously, with our long bonds rallying significantly, as I mentioned earlier, dropping by almost 300 basis points, that lowers the cost of capital in the economy and the discount rate that people use to value companies. So that was a big positive. And the second positive is people are expecting greater growth. That's the other input that goes into valuations. So if you put the two in combination, you get a significant re-rating, which is what we saw in the market. So if we just look sort of forward to 2025, I think it's going to be similar to 2024 in my own personal view, which is we're going to be thinking more about managing risk in the portfolio than focusing on returns first. The only problem with it is the two risks we see are both things you can't really put in a valuation model. And the one is geopolitical risk globally. We've been speaking about the world becoming increasingly divided, and anyone who reads a newspaper or watches the news can see that playing out right in front of you. And with the political changes we're seeing in all the countries, it's not clear what the policies are going to be over the next year. So it's just something to think about in the portfolio. And locally, it's the same in my point of view, and that's the political risk. If we wake up tomorrow and the government of national unity is dissolved, for whatever reason may happen, asset prices could react very, very differently from what they did. And I think it's very interesting when I listen to some people talk or you look at what the media said. It's almost like, it was so obvious that everything was going to work out fine during the election. But we could have been in a situation where, instead of the government of national unity, we had the ANC together with the MK and the EFF. And I can pretty much promise you that the government bonds wouldn't be trading at where they were at the moment. So it's just thinking about that in the portfolio. And you also have to think that the SA Inc. shares, whether they're banks or insurers or retailers, are pretty closely linked to what happens to our government bonds as well. The bulls would counter that to say, well, yes, the foreigners have come into our bond market and they bought our bonds, but very little foreign buying in our equity market. So there is this sort of potential, as Brazil is performing poorly, as Mexico started to perform poorly, that some of that money finds its way into the South African equity market. Globally, if we look on the offshore portion of the portfolio, managed by our sister company Orbis, and we manage a portion here out of Cape Town, we remain very underweight the US market and underweight those mega cap tech shares that I spoke about earlier. So our portfolio looks very, very different from the markets and most of our competitors. We're finding value elsewhere in the world. Yes, those US companies are fantastic. They're probably of higher quality, and looks like the US political scene's a lot more stable than we're finding across the rest of the world. But we're just finding better value in Europe, the UK, and in Asia. Sort of locally, with this big rally in the SA Inc. shares, and unfortunately last year we didn't have enough exposure to SA Inc. and we didn't have enough exposure to South African long bonds, but given the significant move in many of those share prices, we've actually been taking some profit. So as a citizen of South Africa, I really hope what's discounted in the share prices turns out to be true. But when we're looking at it, some of the valuations we think have moved a little bit ahead of the fundamentals, and we've kind of taken some of that profit and we've recycled it into some of the multinationals, sort of like ABM Bev and Mondi, which have underperformed the local shares last year to quite a significant degree. So when we think about it, I think it's more a year of managing risk. When I look at the portfolios, we can still find a fair amount of value. And I just wanted to say to everyone, when we're putting the portfolios together, we are thinking of getting a diversified sort of portfolio of undervalued assets. So I just want to say thank you again for listening, and I hope 2025 turns out to be a better year than I think it's going to be.